Hey everybody, welcome back to Dividend Stockpile, where we talk about all things dividend and income investing related. In today's video, we're going to talk about how to value a dividend growth stock. Now, with the market at all-time highs and value seems to be hard to come by, it's important to understand how to determine whether a stock you're looking at or a stock that you already own is a reasonable value. And so in today's session, we're going to be talking about four different ways to value a dividend growth stock. The four ways we're going to talk about is the dividend discount model, the discounted cash flow model, dividend yield theory, and price to earnings or PE mean reversion. Now, I will note that no valuation method on its own is perfect, and valuation is both an art and a science. And so we'll talk about the numbers, but there's also a human element. You have to determine if the numbers make sense, and that's where the art comes in. So in today's video, we're going to be using Coca-Cola, ticker KO, for our example, and we're going to use real-world data to calculate the current value of Coca-Cola. So let's get started. Okay, so the first one that we have is a dividend discount model or DDM. So what this particular model does is it calculates the present value of a stock based on its expected future dividends. So the calculation is the expected dividend per share 1 year from now over the cost of capital, which means your required rate of return, minus the dividend growth rate of the particular company. So remember, this only works if the dividend growth rate is lower than your required cost of capital. So let's look into the details of how to find this information. So for Coca-Cola, the expected dividend per share is you take the current dividend of $1.94 per share per year and multiply it by the dividend growth rate. Now you can project what the rate is going to be going in the future, or you can use historical numbers. I've used the 5-year historical number for Coca-Cola's dividend increases, which comes out to 3.93%. So using that, it comes up with the future 1 year from now expected dividend. The cost of capital is really up to you. I use 8% for all of my calculations, but if your required rate of return is higher, say 10 or 12%, use that number. But just know that the valuation is going to come in much lower because there's a higher hurdle in order to make your money that you want at that 10 or 12%. And after inflation, the market has gone up about 8% a year for the last 90 years. So it's a good estimate, especially for dividend stocks. And then the dividend growth rate, you can find that on most financial channels, different websites. But I rounded up to 4%. The actual 5-year rate is the 3.93 I mentioned earlier, but just to make the calculation simple, rounded up to 4. Okay, so using that information about Coca-Cola, we found that the 1 year dividend from now is expected to be $2.02, and the required rate of return is 8% minus the 4% dividend growth rate that Coca-Cola has, and the dividend discount model valuation comes up with an estimate of about $50.50 per share for Coca-Cola. This particular foundational model is valuable because it focuses on the primary reason why we invest in dividend stocks, and that's for the dividend itself. Okay, so next up we have discounted cash flow, and discounted cash flow calculates the current value of the stock based on what earnings you expect in the future. So this one looks confusing, but it's really not too bad. So the value, the way you calculate it is take the earnings per share times 1 plus the earnings growth rate that you or the analyst expect, raise it to the number of years in the future, and then multiply that by the average PE ratio of the last 5 years. You take that whole number and divide it by 1 plus your required rate of return, raised to the number of years in the future. So that's a lot of information. So let's talk about each one. The EPS is earning per share, and you're going to want to pull up the last 12 months. And you can find that on pretty much any financial website or the company itself. The earnings growth rate is what you or analysts you follow expect the earnings growth of Coca-Cola to be. Again, you can find that on most different financial websites. Seeking Alpha is where I use it, and it always has very good, reliable information. I will include an affiliate link down below if you want to check out Seeking Alpha for yourself. Number of years. I always do 5 years because it's really hard to forecast much farther than that in the future. I mean, just look at what's happened over the last 5 years. If you would have done a calculation based on a 10-year or 15-year time frame, there's no way you could forecast that. So I think 5 years is a sweet spot. Average PE, that's really whatever the company has done. And again, you can find that on financial websites like Seeking Alpha and others. You just want to know what the historical PE ratio is. And then again, the required rate of return is really up to you. Again, I'm going to use 8%. Okay, so looking at the details for Coca-Cola, this is what we have. So the earnings per share over the last 12 months is $2.41 per share. The earnings growth rate that analysts are expecting is 4.85% for the next 5 years in the future. The average PE ratio over the last 5 years has been a 26.5 PE ratio. And again, my required rate of return is 8%. So putting that all into the formula, we have $2.41 times 1 plus the earnings expected growth rate of 485. Raise that to the 5 years, and then multiply that by the PE, which is 26.5. And then you divide all that by 1 times your required rate of return, which is 8%, raised to the number of years, again, 5. So when you put that calculator into Google Sheets or do it on your own calculator, a DCF estimate comes out to $55.08. Okay, moving on to the third valuation method, it's dividend yield theory. And this calculation is based on the fact that a well-established, stable company will revert to the historical average over time. So the calculation itself is relatively easy. You take the current dividend payment over the last 12 months, so just add up each of the quarterly payments or monthly payments, and divide it by the historical dividend yield. And you can find that on pretty much any financial website like Yahoo Finance or Seeking Alpha or any of the other ones. Okay, so again, these are the inputs you need, current dividend payment and the historical dividend yield. Based on that, looking at Coca-Cola, we have a current dividend payment of $1.94 per share, and the historical dividend yield of Coca-Cola is just under 3% at 2.96%. Putting that into our simple calculation, the dividend yield theory estimates that Coca-Cola is worth $65.54. And rounding it up, we have our price to earnings or PE mean reversion. So again, this one in particular is saying that a stable, well-established company will revert to its historical averages over time. It might take some time to get there, but generally speaking, it always reverts. The calculation on this one is very easy. You take the current earnings per share over the last 12 months and multiply by the historical price to earnings. Pretty simple. So using that, these are the inputs that you will need. You can get that on any financial site. Putting it in for Coca-Cola, we have $2.41 in current earnings and a historical PE of 26.5. Calculating that all together, it comes out to a PE mean reversion estimate for Coca-Cola at $63.86. Okay, so here's a summary of the different valuation models. Discounted dividend model is $50.50. Discounted cash flow is $55.08. Dividend yield theory is $65.53, and the PE mean reversion is $63.86. So now what do you do? Well, this is where the art comes in. There's no one exact method that works best, so you have to either determine which of these four models is most accurate or most likely for your particular company. Something like Coca-Cola that's been paying dividends for a long time, maybe something related to the dividend makes more sense, so either the DDM or the DYT. But it's really up to you. You can take an average of all four. You can estimate based on which ones you think are most important. The current price as of today for Coca-Cola is $63.39. But using these valuation methods, my personal opinion is it's probably somewhere in the $58 to $60 range is probably fair value based on the historical numbers that we see based on these models that we calculated. So with it being $63.39 today, it does appear to be slightly overvalued, about 5% or so. So nothing too extreme, but it's also not a value today. So with that information, you can make a determination whether you feel like it's a good time to buy the stock or not, or you can wait for a better price using your methods. Okay, so thank you for joining. Hopefully this was useful. Hopefully you learned something from it. Let me know which model you like the best, and if you use valuation in your consideration, or do you just buy and hold over time. Thanks again for watching, and remember, keep stockpiling those dividends.